Shane, and good morning, everybody. A very warm welcome on this frosty autumn day. As Shane mentioned, I'm Monique Sharland, CEO of the National Franchise Group Business Accounting Network, and my speciality is the small and medium enterprise tax law, as well as expert in the franchising arena. I'm recovering from the tail end of bronchitis at the moment, so if I do cough, I really do apologize beforehand. But law can be very boring to some, and I'm afraid I can't possibly make law entertaining for you in this next hour. I'll try my very best. And this is probably why a lot of small business owners don't really understand the difference in law between what their obligations are if they are running a company, or as opposed to a sole proprietor. So today, or for the next hour, we are going to look at the very basic laws that form the foundation of why annual financial statements may differ, quite substantially, in fact, between companies and sole proprietors. And by the end of this webinar today, I'm sure you will start realizing that it's putting the high costs of running a company more into perspective for you. So we won't be looking at the actual company annual financial statements in this particular webinar, but next month, my learned colleague, Madeleine Proprietors, will be providing you with a webinar, also for an hour, as to the more detailed aspect of annual financial statements for companies and how to read those annual financial statements. I'm going to look at the closed corporation status because the title of our webinar today is Companies' Annual Financial Statements Compared to Sole Proprietors. And the question most of you, or many of you, might be asking is, where do closed corporations fit into this equation? So let's just look at the status at the moment. Closed corporations, as we all know, can no longer be formed. And this is since the New Companies Act was promulgated in May 2011. And closed corporations are included under certain provisions of the Companies Act. And that's actually very important to understand as well. Not entirely under the Companies Act, but there are certain provisions that they do fall under. And closed corporations are not required to be independently reviewed under the Companies Act. But if certain criteria are met, a closed corporation might be required to be audited. Now, closed corporations are treated as companies in terms of all tax laws. Likewise, members of closed corporations are treated in the same way as company directors in terms of tax laws. However, there are some minor differences between the accounting officer report to a closed corporation and the accountant or the compiler's report to companies. And in addition, members of closed corporations are not required to report to the closed corporation, whereas directors of companies are required to present a report to the company in their annual financial statements. So much of what we are going to discuss about companies this morning applies to closed corporations as well, unless I specifically exclude a closed corporation. And the financial reporting standards related to financial statements of closed corporations also falls under the Companies Act. And it's treated in the same way as companies. You might be asking, what is financial reporting standards? And we're going to look at this more deeply later on in the presentation. The financial reporting standards is pretty much a method of bookkeeping, if you can put it in a simplified form. It's a very different way of bookkeeping, and we will compare the financial reporting standard of a company versus a sole proprietor later on. The future of closed corporations and the CC Act will eventually, in time to come, be dissolved, leaving business owners to decide whether to convert the closed corporation to a company, or your other choice would be to sell the business as a going concern back to the member. In other words, become a sole proprietor or members if there's more than one member, and that would therefore be a partnership. Now, when this day dawns, business owners need to seek professional advice from their accountants before taking any decisions. 2011 statistics reveal that there were 2 million registered CCs at the time, or in 2011, at the time that the New Companies Act was promulgated. Of these 2 million closed corporations, a whopping 76% of them were what we call owner managed and had turnover of less than 1 million per annum. So in other words, most closed corporations registered at the time are not even classified as small businesses. They are classified as micro businesses. And unless there are specific circumstances in a CC, it would make no sense for these particular closed corporations to convert into a company, as the cost of running a company would certainly exceed the benefits of being in a company. So let's look at some of the legal statutes that are governing companies and sole proprietors, particularly when it comes to annual financial statements. The first one is the Companies Act. Now that obviously applies, if you'll see there's a column for company and a column for sole proprietor. Obviously it does not apply to sole proprietors, but it does apply to companies. And this is quite an onerous act. There's the Income Tax Act, the Tax Administration Act, and other related acts, if applicable, for example, Value Added Tax Act. So that would apply to both companies and sole proprietors equally. But the legal implications of a company under the Companies Act is onerous and it's expensive. When you compare that to a sole proprietor, it's simple and it's much less, it's inexpensive. So let's compare some of the management of a company versus a sole proprietor. Now, closed corporations, members must be natural persons or a trust. A company cannot be a member of a closed corporation. Under companies, the ownership are shareholders, as you would get members in a CC. But those shareholders can either be a natural person or a company or a trust. Whereas, of course, a sole proprietor can only be a natural person. The management of a company is the director. The director manages the company. They would be a natural person, and they don't necessarily have to be the shareholder either. Whereas the sole proprietor is the owner as the manager, and that person obviously is a natural person. Now, this is a very important aspect to understand between companies and sole proprietors, and that is the employer-employee relationship and the comparisons between a company and a sole proprietor. A company is automatically deemed to be an employer of the directors, who are deemed to be employees in terms of the Income Tax Act. And why this is significant is that a company has to register as an employer with SARS. And the director is subject to PAYE on their remuneration. And that remuneration includes, obviously, salaries, bonuses, including fringe benefits, use of company cars, and so on. And that return, or companies need to register as that employer with SARS, even though the company is owner managed. In other words, there's only one shareholder who is also the director. The reason for this is that the legal relationship between a company and a director are two completely separate legal entities entirely. And very often the small business owner thinks that because they're the director of the company and the owner of the company, they're one and the same. The law sees them entirely separate legal entities. So the company must deduct PAYE from the director's remuneration on a monthly basis, and they submit this amount together with an EMP 201, which is the SARS return, which is due by the 7th of every month. And even though the director might not be earning an income from the company, he or she is still an employee of that company. And a return, even though it might be a nil return, must still be furnished to SARS on a monthly basis. This is very important to understand because obviously the costs of running a company just with this relationship of company employer and director being employee is going to increase the cost of a company, because if you compare that to a sole proprietor cannot be an employer of him or herself. There is no employment relationship at all. So a sole proprietor does not register for PAYE unless, of course, he or she is employing other people other than himself or herself. So they would pay provisional tax, in other words, every 6 months as opposed to every month, which is PAYE. So again, you can already see that the costs of a company or being a company director increases purely just on this basis alone. Right, let's have a look at some legal statuses between a company and a sole proprietor. And although this has got nothing to do with annual financial statements or linking the basis of law to annual financial statements, I thought I'd bring it in anyway so that you can see why some people would form companies and why some people would not. So the first thing to look at in a company is the longevity of a company. A company will continue, because it's a separate legal entity, it continues even after the owner dies. Now, that is only provided that there is a proper succession plan in place. The company will still continue living, sure, but the business itself might not, which means that a succession plan is absolutely critical in any company, even especially owner-managed companies. And if you, as a business owner, would like to leave a legacy, you would really need to consider a succession plan. The difference now with the sole proprietor, as soon as the business owner or that sole proprietor dies, the business dies in the death of the owner. That means if that sole proprietor is employing any employees, the very day that that sole proprietor passes away, those employees have lost their jobs. So company, even though it continues living after the death of a shareholder or director, it effectively dies if there is no succession plan that has been effectively been actioned. And then business owners, particularly sole proprietors, need to consider their employees should they die, since upon the owner's death, the employees effectively become unemployed. And business owners have worked very hard for many years to build up a reputable business with much financial sacrifices along the way. So therefore, they need to think about their family and passing on their business legacy, as without a succession plan and upon their death, their business value will plummet if there is any value left in the business at all. So the company becomes high risk, in other words, and it might not even be saleable. Personal liability. A company has what we call a limited personal liability of the directors. Now, in the Old Companies Act, that limited personal liability extended quite far. With the New Companies Act, the directors can still be held personally and criminally liable under certain circumstances, which never happened under the Old Companies Act. And it's important for directors to know exactly what their responsibilities are, because they can, as I said, be held personally liable and criminally liable. Whereas a sole proprietor, there is no limited personal liability. So if creditors are unsatisfied or dissatisfied and they have not been paid on time, they can attach a sole proprietor's personal assets, their house, their vehicles, their furniture, their washing machine, their tumble dryer, whatever, in order to liquidate the debts owing by the sole proprietor. This can happen in a company as well, with directors that have been proven to be delinquent directors, where they have been trading recklessly, and there are other certain circumstances as well within a company. However, there is more of a personal liability assurance in a company. Right, let's look at the accounting records and the legal basis of these accounting records. Explicitly in a company, accounting records are governed by the Companies Act. When I say explicitly, the Companies Act actually lists the minimum requirements of accounting records that a company must have. Whereas a sole proprietor, that is not the case. Sole proprietors are governed just as companies are by the Income Tax Act, the Tax Administration Act, and if applicable and registered, the Value Added Tax Act. Now, the accounting records that a company is required to keep is found under the company regulations of the Companies Act. It's onerous. It does require certain skills and knowledge or qualifications in order to comply with the Companies Act. It includes all company secretarial documents, and we're going to speak about this in much more detail, because as accountants, we find that the company secretarial documents is one of the highest risk areas that we find in small businesses. Criminal offense if the company transgresses either the keeping of the records of the accounting records or the secretarial documents. And just as the sole proprietor, it's also covered by the Income Tax Act, the Tax Admin Act, and the VAT Act. So those are the legal bases of which accounting records need to be kept. Now let's look at the different types of accounting records. I'm going to go to the sole proprietor first, because under the sole proprietor, everything that's listed there includes companies. And this list is by no means exhaustive. It's impossible for me to actually put down, I probably would have 5 slides showing all the different accounting records that a company would require. So this is just the very basics. A sole proprietor will need to retain customer invoices, and so would a company. Supplier invoices, receipts, all the bank statements, credit card statements, invoices for asset acquisitions, in other words, assets that have been purchased, details of assets sold, and the amount that they were sold for, the date and to whom they were sold, and that's obviously for capital gains tax purposes, and they would need to maintain a cash book. Now, a company would need to obviously have all of those as well. But in addition, a company needs a fixed asset register. Now, the fixed asset register has been defined in the Companies Act quite clearly. Loans to and loans from company shareholders, directors, employees, and prescribed officers. Now, a prescribed officer is not a director or a shareholder of the company, but they are pretty much in control of the company. That would be a prescribed officer, and they are regarded almost as though they were directors. A record of all liabilities, including guarantees, suretyships, or indemnities granted by the company. A record of property held in a fiduciary capacity, including refundable deposits. So if your customers pay you any deposits that you would refund if you don't meet certain criteria, you would need obviously to have a record of that. Statements of every account held at a financial institution, inventory records. Now, directors' remuneration for Section 42 of the Companies Act must be fully disclosed as well in the accounting records. And that is the whole section just on directors' remuneration, which needs to also be transferred to the annual financial statements. And as I mentioned earlier, this is not an exhaustive list of accounting record requirements for companies. Now let's look at the company secretarial records. This is obviously not applicable at all to sole proprietors, but certainly applicable to companies. So the first thing when you form your company, you have what we call a MOI, or a Memorandum of Incorporation. This Memorandum of Incorporation is filed with CIPC. And that is one of the first documents that your accountant is going to need before they can even start preparing annual financial statements. The next thing they're going to need is your share certificates or your shareholders register. Now, an accountant cannot compile a set of annual financial statements or any financial records for that matter without having access to the MOI, to the shareholders register, and clarification of the shareholders. In other words, where are the share certificates? And of course, the company register. Now, without being in possession of a share certificate and a shareholders register, shareholders cannot prove ownership of their company. And that's period. In the old Companies Act, one would register shareholders with the company registrar. With the new Companies Act, that fell away. And it made the onus is now on directors to ensure that a shareholders register as well as the company register is maintained, that the share certificates have been issued, and that the shareholding is recorded in the shareholders register. You can't, if you have a company, you cannot sell your company unless you have your shareholders register and your company register and your share certificates, because you have no proof that you actually own that company in the first instance. And accountants can't draw up financial statements if we don't have these documents, because they don't have proof of shareholding. And this is a requirement to report the shareholding in the annual financial statements. And these records are critical for reporting in the annual financial statements, as well as for the accountant or the compiler to report to the financial statements as required in terms of the Companies Act. So no business owner must register a company themselves or outsource the registration of a company without requesting and receiving these vital documents. So if you paid 1,500 Rand or 2,500 Rand to register your company, I can guarantee you that you don't have the most critical documents, because alone these documents cost probably I mean, just the shareholders register alone can cost you up to R1,000. So the company register and the shareholders register are two separate books, if you can put it that way, that record certain transactions or company secretarial transactions. And sometimes those shareholders registers and company registers are what we call combined. In other words, in one book. Now, the company register, on the other hand, it records the company's directors, the date of their appointment, a letter accepting appointment as a director. There are reports to annual general meetings and annual financial statements. So those that do have companies, you should be at least signing off one resolution each year accepting the annual financial statements. Also, notices of meetings. That should happen every year. A notice of a meeting to approve the annual financial statements, for example, and as well as resolutions and special resolutions. Now, these resolutions are governed entirely by the Companies Act, as well as special resolutions. The difference between the two is the quorum that is required of the Board of Directors to attend those resolutions and the passing of those resolutions. Now, most of our small companies are owner managed. That means that the shareholder and the director is one and the same person. There are no other shareholders, there are no other directors. Even so, you still need to issue a notice of a meeting with yourself, sit around a boardroom table with yourself, conduct the meeting with your accountant and approve the financial statements and sign that resolution. There is nowhere in the Companies Act which says, well, if you're only an owner-managed business, you do not have to follow all the resolutions and special resolution requirements. You still do have a meeting with yourself. I know it sounds crazy, but that is the nature of the Companies Act. And then, of course, there's the annual duty return. Now, the annual duty return it's now got a compulsory attachment to it, which your accountant will complete on behalf of you. And that is a submission of the FAS, which is the Financial Accountability Supplement. CIPC has been nominated in terms of the Companies Act as the authority to ensure compliance of the Companies Act. And what they've introduced under the FAS, the Financial Accountability Supplement, is that you as the director have to acknowledge under oath that your accounting records and your company secretarial records are entirely up to date. And that you do every single year when you submit your annual duty return. If your company has an independent review, and particularly if it's audited, the financial statements now need to be loaded with CIPC. And I have no doubt that they are going to bring this about with the smaller companies as well, because they have certainly found with the smaller companies that there's a lot less compliance, mostly due to naivety or ignorance of the Companies Act, and they really do want to enforce the Companies Act and the transparency and accountability of directors in companies. So none of this applies to sole proprietors, and I'm sure a lot of you have been scratching around thinking, do you have a shareholders register or companies register or share certificate? Well, that's the first thing you're going to need to make sure that you do have. And just to have a look at it, on your left-hand side, that is an example of a combined company register. One section would contain the shareholders' transactions, in other words, the share certificate numbers issued, the name on the share certificates, etc., etc. And behind that book would be all the minutes, the resolutions, and the special resolutions, and the notice of the meetings. Also in that book, obviously, the directors would be recorded, etc. On the right-hand side is an example of a share certificate. Without that share certificate, if you don't have it, you don't own your company. So this is an absolutely critical element of your company, these two documents or these two books. Right, let's look at some of the characteristics of companies, and we're going to look at independent reviews. I know a lot of small businesses are not quite sure what an independent review is, but basically a company requires an independent review if the company's public interest score, PIS score, public interest score is over 100 but under 350. So that we're talking about a medium-sized company here. So you're talking about a company that has probably at least 100 employees. The public interest score, if it's under 100 and the company is non-owner managed, it will require an independent review. And we're going to come back to this word owner managed versus non-owner managed. So this means that even if it's a micro company, a tiny little company, it will still require the companies to be independently reviewed, irrespective of turnover, irrespective of how many employees that company has. Just by the very fact that it's non-owner managed will require an independent review. And if an independent review is required in terms of the company's MOI, so this is the other reason why it is so critical for your accountant to have access to the memorandum of incorporation, because they need to see whether that memorandum of incorporation forces that company to have an independent review or an audit or nothing at all. So what is owner managed or non-owner managed? It means that all the shareholders of the company are also directors. So therefore, if a company has another company or trust as a shareholder, neither of these type of shareholders can possibly be directors. So therefore, that company would be what we call non-owner managed. When it's non-owner managed, as we said earlier, it requires an independent review. And we'll talk a little bit about independent reviews in the next slide or two. And this is a requirement in terms of the Companies Act. So it really doesn't matter how big or small your company is. So it is always prize number one to ensure that your shareholders and directors are one and the same people, and that all your shareholders are also directors. Of course, there would be certain structures under certain circumstances where that would not be the case, and you would be advised accordingly. But it's very important to get the proper advice from your accountant. So let's look at an independent review. What is an independent review, and how does it compare with an audit? So an independent review is a new phenomenon under the new Companies Act, which was promulgated in May 2011. This is something that has been covered by the International Standards on Reviews, which is called ISRA 2400, and the Companies Act refers specifically to that international accounting standard. Now, the work involved in an independent review is anything from 60 to 70% of an audit. So there is a lot of work involved in an independent review. It's not a full audit, but it's certainly a large chunk of what one would normally do in an audit. And an independent review is what we call a negative assurance test. That is, the work does not need to be carried out at the company's premises. It can be like a desk audit or a desk independent review. So the independent reviewer can sit in their office with all the documents, and they can merrily go along their way and do an independent review to see whether anything comes to their attention that needs to be brought up in respect of that particular company. Now, unlike an audit, which we call a positive assurance test, that means that in an audit, the auditors actually physically go to the company's premises. They will physically look, observe the stock tax, observe the cutoff of the stock tax. They would physically go and check that the assets on the fixed asset register are in fact tangible, and they are in fact there. They will physically, for instance, do a data verification test to make sure that all the customers who owe money to the company do in fact owe that money. There's no material differences. Same likewise with creditors. So they go to a much greater extent to prove the assets and the liabilities of the company. And we call that a positive assurance test. Now, an independent reviewer's report to the annual financial statements provides what we call limited assurance only. So in other words, there is obviously there is room for some error, but if it hasn't come to the attention of the independent reviewer, obviously then they are not going to qualify that report at all. Whereas an audit provides more of an assurance in their auditor's report to the financial statements. Now we're talking about an independent reviewer's report and an audit report. We also talk about a compiler's report. And we're going to talk about the significance of these reports in annual financial statements. It's probably one of the most absolutely important pages to your annual financial statements. and that is what your accountant is actually saying about your company's trading. Independent reviewer and compiler cannot be the same person. They have to be completely separate people, and there's certain qualifications that an independent reviewer would require. And also, it's not required by most small companies. An independent review is not required by most small companies, only if it's been structured correctly under the specific circumstances of that company. So let's have a look quickly at dispelling one of the first myths that we as accountants find a lot when it comes to auditing. Some of you might have companies, and you might have an audit firm that prepares the annual financial statements. Now, because you have an audit firm that prepares your annual financial statements does not mean that your company or your business has been audited. In fact, it's highly unlikely that it would be audited, because the audit fees would, in a small business, probably exceed the entire annual turnover of that company. And it's important to understand the difference between an audit, an independent review, and your financial statements literally just being compiled by an accountant. If your financial statements have not been audited, it means that there's no assurance that your accountant will provide in their report to the annual financial statements. And again, here comes this report, the accountant's report. That accountant's report is absolutely so significant, because if your accountant's report is what we call adverse, or it's a qualifying report, in other words, maybe it qualifies the fact that the company is no longer a going concern, which means theoretically it is in fact insolvent. That is a qualifying statement in an accountant's report, and they have to report that in the company, or to the company. Now, of course, you can imagine your creditors and your bank manager, when they receive a copy of your financial statements, they're going to want to call up all their loans, because they're going to be afraid that they're not going to get paid. So having a qualification by your accountant in their report to your annual financial statements is a serious matter. And it's something that your accountant will always discuss with you before signing off those annual financial statements. And they will discuss it with you in such a way as to how can you turn this around? Is it possible to turn the situation around so that they don't have to qualify the report? No audit means it's not designed to detect fraud or other devious or dishonest activities. So a lot of the time, a lot of small businesses think that because their accountant compiles the financial statements, if there was any fraud or any shenanigans going on in the company by their employees or by their partner in their business, that will be detected. Well, that is not the case, and that's never going to be the case, not even in an audit. So it's not designed to detect fraud or other devious activities. Now, an audit is extremely onerous. It's time-consuming, it's complex, it's strategic, it's methodical, and it really does require top skills, either a partner or an audit manager. And it's always a chartered accountant. And it always has to be a chartered accountant registered as an auditor. Now, not all chartered accountants are registered as auditors. So that's very important to understand that difference. So many positive verifications and analytical tests need to be done in an audit. Hence, an audit is very costly. Okay, so let's now look at the income tax basis between a company and a sole proprietor. And the reason why we're going to look at this is because we're going to look at two different ways that accountants can draft up annual financial statements. And if you understand the tax base or the income tax basis, you can better understand why certain annual financial statements compared with another set of financial statements can differ so tremendously. So in a company, the income tax payable in a company is on its net taxable profit, and that is after deducting the director's remuneration, which is subject to PAYE. So you, the director, have already paid tax on your earnings. Whatever might be left in profit in the company gets taxed accordingly in the company. So now you've got two different taxes. You've got the tax of the company as well as the tax of the director. And if you have to compare that with the sole proprietor obviously only has one tax, and that's the tax of the actual sole proprietor themselves. And they are taxed on the net taxable profit only. So just another myth to dispel. A lot of sole proprietors think that they get taxed on what they draw out of their business. In other words, they're drawing. So let's say they spend certain money out of the bank account on personal matters, whether it's their home rent or whether it is their groceries or whatever the case might be. Those are called drawings. You're not taxed on that. What you are taxed on is actually the net profit. So drawings by the owner is not regarded as a salary. There is no salary in a sole proprietor. Therefore, drawings has no bearing on the income tax. It only has a bearing on possible solvency in the business. So if you obviously draw more money out of your business than what your business can afford you to draw out, you will obviously put yourself into an insolvent situation. So that's the income tax basis. So let's look at the rates. So for a company, they would submit annually an IT14 return. Now that IT14 return alone can be very complex. The rate of company tax is either 28% of net taxable profit, or it's going to be small business corporation tax if that company is a qualifying small business. And then if you're not sure, you can obviously speak to your accountant. Unfortunately, small business corporation tax excludes a lot of owner-managed companies. For example, if you're an architect or if you're a consultant or you're a draftsperson or you're an accountant or you're a lawyer, you work for yourself. By the very fact that you offer a personal service, you are excluded from small business corporation tax. And you would probably be subject to the 28% on taxable profit. But then at the same time, you'll be drawing out remuneration, which you're going to be paying PAYE on, and you will need to submit an IT12 return in exactly the same way as the sole proprietor does. So here comes in the extra cost for a company, which is that IT14 tax return, which obviously a sole proprietor does not have. The company will pay provisional tax as well every 6 months, and so does the sole proprietor pay provisional tax every 6 months. So if you are a company, you're going to pay provisional tax in the company as well as a director if you earn other income other than a salary from the company. So the financial reporting standards we spoke about right at the beginning of this webinar, and as I mentioned, it's almost like a different way of bookkeeping or accounting, if you can put it that way. So one of the standards in the Companies Act, and this is purely for companies, this is not sole proprietors, is IFRS, International Financial Reporting Standards. Now, it's not applicable to small companies or companies that do not require an audit. A company that does require an audit, either it will say so in its memorandum of incorporation, or if you've never changed your old association memorandum of association, which was the Companies Act prior to 2011, all companies prior to 2011 required an audit. That means, irrespective, your company is going to require a full audit if you have not upgraded and lodged a new MOI with CIPC. Right, IFRS for SMEs, that's International Financial Reporting Standards for Small and Medium Enterprises. Now, this is definitely very significant amongst our small companies. And the bookkeeping or the accounting method used here is what we call a fair value basis. So the profit or loss, when you look at the income statement of the financial statements, does not equate to the taxable profit or loss at all. It's very, very different. Now, a fair value basis for IFRS for SMEs basically means that all the assets need to be fairly valued. And we're going to go through some of the, in the next slide, some of the judgments and some of the estimations you as directors need to make and provide to your accountant before they can compile the annual financial statements. So the most important thing to understand here with IFRS for SMEs is because it's a fair value basis from a bookkeeping side of things or accounting side of things, the profit is not the true profit or the taxable profit of that particular company. Right, and then we come to the tax base, which is what we call the historical cost base. So in other words, we do not fair value or revalue any of the assets. And this is exactly in accordance with the Income Tax Act. So the profit or the loss that you see in your income statement equates to the taxable profit or loss. excluding permanent differences. Now, permanent differences would be expenses that you put through the income statement, which is not tax deductible. For example, fines, penalties, certain donations that don't fall under Section 18A, etc., etc. Right, let's look more closely at IFRS for SMEs, okay, which is, again, as I reiterate, this is purely based for companies and not for sole proprietors. But it can also include closed corporations, because closed corporations also fall under this section of the Companies Act. And that is if the public interest score exceeds 100. Right, so IFRS for SMEs, fair value of all assets and certain liabilities. So basically, as the director of a company, you need to go through your fixed asset register with your accountant, and let's just say you have got motor vehicles. Maybe you're a delivery company, and those motor vehicles, you might say, okay, you might keep those motor vehicles for 5 years before you replace those motor vehicles for delivery, which means that there must be a value, or what we call a residual value, of those motor vehicles after 5 years. You need to make a judgment or an estimation as to what that value is going to be. So that might mean that you have to pick up the telephone and phone the dealer and say, look, in 5 years' time, what will this particular motor vehicle's value be? You can do that. And you need to provide that to your accountant, because what they will do is they will depreciate that asset up to that particular residual value over those 5 years. That is what we call fair valuing. So in other words, they're not writing off the asset in terms of tax law, which requires us to be able to write off, say, some of the vehicles over 4 years, if it is a delivery van, or if it's a motor vehicle over 5 years. They will write off the vehicle only up to the point of the residual value, which means that the depreciation for accounting purposes is different to the depreciation for tax purposes. This difference creates what we call a deferred tax liability, which means it's going to appear on the balance sheet of the company. And I'm just using one fixed asset as an example, but it goes into a lot more depth. And my colleague, Madeleine Proprietors, will be going through in more detail the IFRS for SME adjustments that are required to present fairly the financial statements of a company. And also what the director's responsibility is in determining those kind of judgments, like residual values and estimations. And the estimations, say, for instance, would be the 5 years that the company expects to keep that particular vehicle. It gets quite complicated. So fair value of all assets, and then there's certain liabilities that would be fair valued, and they would be fair valued at an amortization cost using the effective interest rate method, which would obviously, the balance on those liabilities would differ substantially to the liability on the actual statement. So let's say it's an installment sale agreement. The balance on the installment sale statement will not reflect the same balance as in your financial statements, because your financial statements for accounting purposes would have used amortized cost using effective interest rate method. Tailored for small companies, IFRS for SME, believe it or not, I know it sounded like quite complicated when I was explaining how to fair value certain assets and liabilities, but it is tailored for small companies as opposed to full IFRS. And the reason why it's tailored that way is because the disclosures are not nearly as onerous as full IFRS. It focuses on information needs of lenders to the company. That is IFRS for SME. So lenders to the company includes its shareholders. So this is why if there are shareholders that aren't directors of companies, the Companies Act forces the financial reporting standard to be IFRS for SMEs, minimum, if obviously the PRS score is prescribed. So you can understand why we would sometimes need to use IFRS for SMEs if the shareholding or the shareholders are not all directors. Now, it's an internationally recognized standard, so anybody picking up a set of annual financial statements anywhere around the world can read it, and they know exactly that if they compare those annual financial statements between other companies, it improves that efficiency of the business records right across the borders. So they all know any users of those financial statements or lenders of those financial statements internationally, they can compare company with company, like for like, apples with apples. Right, so the financial reporting standards, let's look at the legal status. In other words, what is the legal basis of these financial reporting standards? So the company, that's governed by both the Companies Act as well as international accounting standards, IAB, I think it is. Now, those are standards that accountants are qualified, they write exams on it, and they are qualified to do. So being in a company and drafting your own set of financial statements to comply with all these standards, you need to be qualified as an accountant to do so, literally. Of course, this does not apply to sole proprietors. And again, here's the cost variance. Comprising company, we've already said, IFRS, if the financial statements are required to be audited, IFRS for SME or their own framework, and of course the popular one is the tax base. Now, if you compare that to sole proprietors, the only one is tax base that would be used. A sole proprietor only requires 2 documents once a year, no more, and it's for SARS. Not for other users, not for management, but for SARS. And that is an income statement, number 1, and number 2, a statement of personal assets and liabilities. That is literally all a sole proprietor needs to prepare. When you look at a company, on the other hand, it becomes a lot more onerous. First of all, there needs to be a report from the compiler, that's the accountant that drafted financials, as well as a report if the financials needed an independent review, the independent reviewer's report, the statement of financial position, which in the old days was called a balance sheet, statement of comprehensive income, in the old days we called it an income statement, statement of expenses, a cash flow statement, in other words, historically, where did the profits of the company, how was it expended? Notes relating to the results. Now, there are minimum requirements in those notes to the financial statements required by the Companies Act, but also under IFRS for SME. Those disclosures and those notes to the financial statements are governed by IFRS for SME. The documentation to substantiate these financial statements becomes quite onerous. For a sole proprietor, none of it's applicable. But when it comes to a company, the accountant needs to do a test called a materiality calculation. And that test is to ensure that anything that goes above a certain amount, they need to look at more deeply, because the financial statements of a company cannot be misleading or false. And the only way for a compiler or an accountant to determine whether financial statements could be misleading or false is to first of all calculate a materiality figure. Then they've got to prepare working papers for every single balance sheet item that appears on those financial statements, as well as certain income and expenditure accounts. And that must substantiate the materiality assessments that they have set. They need to comply with international standards on related services, which is a 4410. This is not law itself, but it's connected to the Companies Act. And basically what it means is the accountants have to comply with integrity as well as law and regulations. When it comes to a sole proprietor, the accountant all they will do is enter into an agreed upon service engagement. Now let's look at some of the responsibilities, and I think this is also going to squelch probably myth number 3 between a company and a sole proprietor. Compliance with the Companies Act and regulations, the entire responsibility and onus is on the directors, nobody else. Obviously with sole proprietors that's not applicable. The accounting records and maintaining those accounting records in terms of the Companies Act is the sole responsibility and onus of the director. Under sole proprietors, that is of the owner of the sole proprietor. Company secretarial records, the responsibility lies entirely with the directors. Sole proprietors, that's obviously not applicable at all. Financial statements and annual financial statements. There is a definition of financial statements in the Companies Act as well as annual financial statements in the Companies Act. Financial statements are things like management accounts or interim financial reports. Annual financial statements is obviously issued annually. Both of those, management accounts as well as annual financial statements, are entirely the responsibility of the directors. It's not applicable to sole proprietors. Annual income statement and statement of personal assets and liabilities. Obviously, a company does not have to provide that, but the owner or the sole proprietor does in his tax return. That's his responsibility or her responsibility. All tax matters, right throughout all the laws, income tax, VAT, employees tax, etc. Everything is the taxpayer's responsibility. In the company, it's the directors, and the sole proprietors, the owners. So you'll notice here, nowhere does it say that if you engage an accountant to prepare your annual financial statements, or an accountant or a tax practitioner to prepare the tax returns of the company, that it's the tax practitioner or the accountant that is held responsible. In law, they go for the director first and foremost, always. Sole proprietor, in law, they will go for the sole proprietor, always. So it's very important to know that you can't put your head like an ostrich in the sand and say, well, I've already delegated this to somebody else, so it's not my problem anymore. It's always your problem. It's always your responsibility. And you would always be the first person or the first port of call in terms of law. Now let's take a look at an example of the following, just for comparison purposes. Annual financial reports required for a sole prop and annual financial statements for a company. Okay, here is a sole proprietor, and this is an income statement for a tax return, and you'll notice it's a one-pager. All you've got to show is the income received and the various expenses and the net profit, and then they sign it off. That's it. That is all that is required in terms of law for sole proprietors. Obviously, if you need financial statements as a sole proprietor because you need to maybe apply for overdraft facilities or renew overdraft facilities, you need to chat to your accountant about that. That would be over and above the law, but this is the basic requirement in terms of law. Very, very, very straightforward. And of course, all the documents to support the customer's invoices for fees received and all the documents relating to all the expenses you need to obviously retain. Let's have a look at the second. So that's the first requirement. Let's have a look at the second requirement, if I can get there. And, oh, sorry, that's one we've already done. This is a statement of personal assets and liabilities of a sole proprietor. So basically, it would be your house. That would always be at cost. So when you look at statement of assets and liabilities, it's always at cost. So all the assets, less any of the liabilities giving less asset value. So guys, you can actually see that there is really very, very little that is required in terms of a sole proprietor. That is just the bare minimum. Now let's have a look at an overview of a company and its financial statements. So this is obviously a fictitious company, as it was a fictitious sole proprietor. And this particular company has had an independent review because it says they reviewed financial statements. We've got an index, and the index starts with general information, report of the independent reviewer, report of the compiler. As I mentioned, these are critical reports. Directors' responsibilities and approval. So the directors need to understand their responsibilities in producing these financial statements, and they need to sign to say that they've approved it. The director's report. So again, as a company director, you have to prepare a report that's got to be attached to the financial statements. Statement of financial position, or otherwise balance sheet. Statement of comprehensive income. Statement of changes in equity. Statement of cash flows. Accounting policies, which is very critical. Notes to the annual financial statements is very critical. Then there's supplementary information, which is not part of the financial statements, but it certainly makes more sense to the management. And that is a detailed income statement and an income tax computation. So this is the general information. The directors have to be listed, the registered office, who the independent reviewer is. Here we go, shareholders. Okay, so we need to know who the shareholders are. Independent reviewers report. So he will report to the directors what the responsibilities of the directors are to the financial statements. The independent reviewer's responsibility. the conclusion of the independent reviewer. This conclusion is critical. If it's an adverse conclusion or a qualified conclusion, remember what I mentioned earlier, it has an adverse effect on your business and your company. So it's imperative that you comply with the Companies Act, but that is certainly part and parcel of an independent reviewer's tasks. Other reports required by the Companies Act, and then of course then the independent reviewer will sign off the independent review report. This is now a separate letter from the accountant or the compiler of the annual financial statements. You'll notice that they're both completely separate people. You can't have the same person. And this is the report of the compiler. And again, that report of the compiler is also critical to make sure that there's no adverse findings or qualified findings. Here is a list of the director's responsibilities, which as a director, you need to be very, very aware of, because you sign this every single year with your annual financial statements, and it's certainly a requirement of the Companies Act. And then we have the director's report. This is the report you as the director of the company needs to insert into the financial statements. But don't worry, your accountant will obviously assist you with this report and go through it with you. The most important part of the report, including the accountant's report, is the going concern. Is this company solvent? Is this company liquid? Can this company pay its creditors when they become due? Events after the reporting date. This is obviously a very critical factor as well. It could be the company could be in a litigation process, for example, which could substantially affect the financial statements at the reporting date. Any dividends have been issued. Again, the director's report lists the directors, and there we go, the shareholders. So these share certificates and your shareholders register is critical for the annual financial statements. And then we list who the independent reviewer is. So here's just your balance sheet, okay, of the company, the statement of financial position. I hope I'm not going down too fast. This is really just an overview, guys, of what it entails between a company and a sole proprietor. And I'm sure you can already realize why the costs are so much higher. Statement of comprehensive income. That is just literally your turnover, less your operating costs, which is all your expenses and your profit and loss for the year. And then your statement of changes in equity. That is the shareholders' equity. And then we have statement of cash flows. Okay, now this is a very, very important report, and I know that most of us small business owners don't quite understand it. It is important that you ask your accountant, please, to explain it to you. It's a very critical factor, and basically it's reconciling the profit or the loss of the company to where the monies have been expended. Then we have accounting policies. In other words, what are the consistent policies or bookkeeping entries that we do on a year-on-year basis? How do we recognize, for instance, revenue or sales? How do we, for instance, recognize services or interest income? Or how do we provide for income tax in the financial statements? Or how do we write off property, plant, and equipment? Or how do we depreciate it? And when do we recognize it when we bring it into the financial statements? Same with trade and other receivables, cash and cash equivalents. Share capital is absolutely critical, ordinary shares in this particular case. Now, the accountant cannot report on share capital if they don't see the MOI, because the MOI, or the Memorandum of Incorporation, will detail what kind of shares the company has authorized and what kind of shares have they issued. Sometimes they might not be ordinary shares. They might be Class A or Class B shares. They might even be preference shares somewhere along the line. So it's critical for the accountant to have all the secretarial records in order to compile this. More notes to the financial statements. This is the snippet of the fixed asset register, which is your property, plant, and equipment. Trade and other receivables, what it's made up of. Cash and cash equivalents. Fair value of cash and cash equivalents. Here we go. Share capital, authorized shares, and issued shares. This, guys, we get from your MOI. And this is critical to ensure that we have that. And loan from shareholder. So as you notice in the law, you have to disclose loans to and from shareholders. We obviously need to know who those shareholders are. And if we don't cite share certificates and shareholders registers, this is impossible to report on in the annual financial statements. Related parties is a disclosure in terms of IFRS for SMEs. Profit before tax, there's a bit of a tax computation there. And notes to the annual financial statements, we're looking at certain related party transactions, and shareholders obviously is one of them. And these notes are all in terms of IFRS for SMEs. Going concern, obviously this wasn't a going concern, so the accountants and the independent reviewer sat with the owners and discussed exactly what was going to happen to this particular company, and they felt that on the basis of the directors and what their future plans were, that this company could definitely be swung around into solvency again. Here's the detailed income statement. Now, this is not part of the financial statements. It's a supplementary statement. And of course, everybody understands the schedule of expenses. I think you all are familiar with that indeed. And then, of course, here's the tax computation, which is again a supplementary disclosure. So you'll see that we have got 22 pages of annual financial statements for a company, and this is a small company, a relatively very small company. So I'm sure that one can actually understand why it is that financial statements do cost what they do in terms of drafting them and compiling them. Okay, so companies are a far more expensive entity to run than a sole proprietor. And so if you are an owner-managed small business trading in a company, you need to consider obtaining advice from your accountant to determine the correct and most cost-effective structure for your business. And next month, on the 27th of June, my colleague Madeleine will present also annual financial statements, but she's going to go more in depth as to IFRS for SMEs compared to the tax-based accounting. So she's actually going to look at sets of annual financial statements so that you could get a better understanding of reading your financial results. Okay, that's all we have for you today. Are there any questions, Shane? SMEs, when you do a voluntary audit. Now, if we look at the regulations of the Companies Act, specifically under section 20, I think it's 27 or 28, if a company requires an audit, they are very specific to say you must prepare it in terms of full IFRS. So even if it's a voluntary audit, the section 28, as far as I recall, does not specify whether it's voluntary or not voluntary audit. It just specifies that the financial reporting standard required for any audit requires to be full IFRS. I can certainly confirm that later with Jolene, but that's certainly my understanding that any company, voluntary audit or not, requires full IFRS.